Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Tuesday, November 14th, 2023. I wanted to get a video out, a lot of movement in the markets today, and wanted to just go over the charts. As I've been doing a lot lately, we'll keep it with just the equity markets and the bond market. Again, those two are sewn at the hip right now. And so I wanted to go over both the key levels to watch and some trading strategies here. So this is QQQ. This is a daily chart. It's been quite the lift. And again, make absolutely no mistake about it. This is 110% contributed to the reversal in interest rates that have taken place and Treasury bonds especially. And you can watch, we've been trading the 30-year because that's more juice, but the 10-year is the one the markets watch. And I'm going to get to those charts in a second. So, we still have, nor have I ever eliminated that marginal new high scenario. And look, we're in spitting distance of it now. So I wanted to share my thoughts. Here's my thoughts. So that was never taken off the table. Still is, obviously, at least in QQQ, more likelihood. I doubt we'll see it in SPY and in the other diversified indexes, the Wilshire and all the more balanced indexes. But you're very close in SPY. But let me show you why we probably won't get the marginal new high scenario, which for those of you new, it's this. I've had this line here, and that's not the exact line. It just says a marginal new high means what I'm referring to is a high, slightly above the previous high. That would, I think at the time, and I'll still maintain, I was saying roughly anywhere from 2 to 5%, somewhere in that area, ballparkish. And that would pop a lot of stops, suck in a lot of longs, blow out a lot of the shorts. And then if it happens, again, we'll have really big negative divergence on QQQ. Now remember, we already had divergence here. That is still the high. The S&P and all other indexes are still they're right now trading above their downtrend lines, but these are daily charts, so how you close the day matters today. That's one thing I'll be looking for. I don't really expect a fall back below those trend lines today. If anything, it's probably going to happen on a weekly basis. So let's see how that would look here on QQQ. You go to a weekly chart. I have a lot of different boards. It would look like this. That divergence, when you see big divergence on a daily, I'm talking multi-month, then that usually conveys over to the weekly chart, and that's what we have here. So this is what that was just the downtrend line that we had in QQQ. So we've already popped that. I'm going to put in the divergence line now, and it would look something like this. And remember, that is, when I say a marginal new high, by the way, I'm not talking about a new high, all-time high in QQQ. That's up here. Talking about a slight pop over that previous high from mid-July right there. And so that would give us something like that. Run up. You have a back test of a uptrend line right there, primary uptrend line, roughly there. And then the reversal sets in. And, right now it's still, as close as we are to doing it, it's still just my alternative scenario. I'll show you why. 60-minute chart. Let's jump back down to that. So what I'm going to do is take you through QQQ, the Magnificent Seven, as they've been since most recently named, because we used to have the old fangs, and some of those don't have the weighting that they used to anymore, over time market changes. But the Magnificent Seven have not only do they account for the bulk of the returns in the NASDAQ 100 and the S&P 500, at least to a lesser extent than S&P, but they also have outperformed, so it's that's what they've given almost all the juice to QQQ pretty much since the beginning of 2023, so most of the year. Okay, let's just go over the facts, the technicals. So the divergence that we've been talking about, and I always say divergence is not a sell signal, it's an indication, conditions that the momentum is waning, and we still very, very much have the negative divergence that we had when we went into the day today. So it's only been extended, and there's no guarantee it can't be taken out, but as of now it's there. And so I like to say, not always, but more often than not, that'll play out for a trend reversal. Now, I also say this, an index is simply the sum of its parts. So you want to look at the S&P 500, you want to do a true deep dive, you can go over 500 charts. So all roughly 500, it's 400 and something, I think now. Same thing with the NASDAQ 100. But you don't really need to do that in the NASDAQ 100 if you're trading, unless you're trading the equal weighted, then it's important. Otherwise, you just look at the MAG 7, again, because of their unusually large weighting. As I often talk about, the NASDAQ 100 is so undiversified due to if you look at the weightings, that it's really more just a tech. It's like trading a tech ETF. XLK is the tech ETF that tracks the tech sector. But all right, let's just look at the charts, and then I'll wrap this video up and get it out to you. There's Apple. Apple took out, as I said, going into earnings, it had a very bullish chart. One of the most bullish of all the things. Positive divergences on the 60-minute, clean 60-minute divergence, daily divergence, which some didn't have on both indicators. And the rest is history. They reported, they took out the minor trend line, then they went and took this one out, and it's been one of the best performers. And again, the chart reflected that at the time. However, where are we at right now? For the same very reasons that the stock rallied due to these bullish, aka positive divergences, just like it had a divergent high right here. At the highs, broke down the trend line, back tested, gave us that biggest drop that we had all year. It was the same thing here. You had a divergent low, you rallied. You had a divergent high right there. You can see the divergence lines. Correction, divergent low, rally. Another correction, bigger divergent low. See, this is an extension of the same divergence right here. So you had one little rally, put in an even larger, same divergence. It just got bigger at that point, and an even bigger rally. Simple stuff, guys, really. I mean, I don't want to oversimplify it, but that's it. And I always say, nobody bats 1,000. You can't count on this, that every time you have a divergence into resistance, it's going to pan out. But there's a big old gap right there. It's a resistance line I've had here for a while, and there's that. So I told you earlier that I was considering, I mentioned that I'm going to watch today, but I've actually have some dry powder. I've made it very clear a few weeks back, said several times, I usually don't do. I made a big shift in 401k money. It's moving a lot of money into Treasury bonds, a big overweighted position. In my swing trading account, that's tactical. I'm in and out all day, long, short. But overall, when I look at all the accounts, multiple accounts, IRAs, regular non-tax or taxable accounts, tax-deferred accounts, college education savings accounts, covered L's that you can actually move money in and to whatever you want, unlike the 529s. And so those are the longer term accounts. And overall, I'm still, like I said, the case to be the intermediate case to be long and bullish Treasury bonds is still very much intact, but I'm about to get to those in a second. So now what I'm doing, again, I'm flipping that hat to active trader mode, shorter term accounts, and I'll make a decision later on longer term accounts, but I think it's a great time to, I'm sitting tight. I told you, came into the day short, because we're at those trend lines. And normally I'd put a stop right above them. I could have easily done that this morning. I said, you know what? We have these divergences. I'm hedged up with treasuries. I'm just going to let these index shorts go for now. And here's why I'm adding. So this is Apple. Very clear. Hot negative divergence, even larger than it was before. You look on the 60-minute chart where we just recently hit that extreme overbought reading right here. Show you, I have a line that is at, where's that number at? Let me give you the value. Show value. No, it should be populating. I have the value up here. I guess it's squeezed. There it is. It's about almost 84. And so what does that purple line represent? 84. Every single index, every single stock, I don't automatically use the default settings on indicators, whether it's any of the indicators. There's dozens. I have a lot parked to the side of my screen here. I usually show the big, my main go-tos, the PPO, the RSI. But that's about the magic number, about as overbought as Apple tends to get. And as I often point out, on these overbought readings, usually it's not the initial tag. For example, there's the initial tag right there. There was another tag right here, and I didn't draw it, but you have divergence. It's usually the initial tag, then you have divergence, then the correction. Initial tag right here, negative divergence, then the correction. And here, well, yeah, that's positive divergence. So there it is, the tag right there, the divergence right here, and then the drop, right? And so there was the most recent tag. Here's the divergence. You can see it also on the PPO, and still very much intact on Apple. Here, I'll zoom in for you so you can see it nice and clean. Again, after the tag of that level. So that's Apple. That's the biggest one. And again, where to? Still looking at these uptrend lines I had on QQQ and everything else. Microsoft. Let me just run through them real quick, and then you can make the decision whether or not to stay short, be short. And I'll get to Treasuries in 1 minute here. So that's the same story, divergent high. We can put up, I didn't have the magic RSI number on Microsoft, but you can do that. It's not hard to do. You just take a look, roll back for the chart, look at where the peaks are. Again, the default on any charting platform is going to be 70 and 30 on an RSI, 30 being oversold, 70 being overbought. But again, that's garbage. It works very well for some securities, but if you start getting out of your longs or starting to short every time, let's say Microsoft here hits 70 on the RSI, well, guess what? You're going to be in for a lot of pain. So I put the line up now instead of also around 80. That seems to be the magic number for these tech stocks, these big Magnificent Seven. And you can see we hit it recently right here and then roll down. The last time we hit it was right here, and that happened. Okay, and we had divergence up to that point because we had a spike above it. There was the initial tag. You can see right here. I think you can see. I'll zoom in. So back here, you had the initial hit, and it was actually a pop above that, rare pop above that level, an extreme. Then you diverged, and then it was on the subsequent tag, and then boom. That was the biggest drop Microsoft had in the last year. So that's that. That's where we're at. And that's why I'm short right now. We have Alphabet. Again, I got this out in the post I said to you this morning. It wasn't some, it was all the Mag 7. I'm just going to zoom in here and show you. Some of these lines I have to update. That's a lot of times I just look at them, I can see the divergence. But when I do the videos for you, I'll update the charts. There's your downtrend line in Alphabet. There's your divergence line right here. Somebody just draw it out in color, and you can replicate these charts. Negative divergence, negative divergence, negative divergence. Let's put up an extreme overbought reading level. And you can see I put it there where it is, at least for the last 1, 2, 3. You can see that either did the trick or it followed. If it didn't reverse right there, which is usually the case, you have that divergent high and then comes the correction. So I came into the day short, nothing crazy again because you had the CPI today, but I'm aggressively short right now in my trading account. And I know, and I'm saying that because I know most aren't. I'll show you something in a second on Treasuries. I know most are probably capitulating at this point, and that's one reason that the market's up so big. I can smell a lot of short covering right now. I can literally just see it in the charts where the levels are and what's going on here. There's negative divergence on Amazon right at the previous high. Let's put up a little. Do I have one already? Nope. We'll do it here. There it is. That's about as overbought as Amazon tends to get right there. That one's about 82, the line right there, a little above 82 on Amazon. NVIDIA, put up the magic line right there. NVIDIA's had some pretty big spikes through it right there. And then this one ended in a divergent high over here. Right there was your divergence. And then you had this correction. It doesn't look like a lot because of scaling on this one. But from that last divergent high, which was, let me just fix these lines. This was a divergent high right here. And NVIDIA fell. I just have to grab it. That height pulled down. That was a 22% drop. Okay, so NVIDIA just tends to move a lot. And there it is. So it hit that level, extreme level, about 80-ish. And with divergence, and two more in the fangs at Mag 7. I just want to cover them all for you. There's Meta. Most important. Well, we actually, believe it or not, this one I said they all had it. This one, you know what? It can be because I've noticed these indicators, when they reverse, they move down, they readjust the line. So as of now, because remember, it's populating. It's constantly calculating this. you have almost an equal high, and ever so slightly higher high now. I'll revisit it later. We'll see if that is adjusted downward. Sometimes I've noticed after the fact, even these spike highs, they change the print and they move it down. But you can see roughly equal highs in the PPO and the RSI right there against higher highs and prices. And the mess, by the way, Meta doesn't move the needle as much as the top 4 or 5 that I just covered you by far. When you get down towards the bottom of the Mag 7, their weightings don't matter as much. And here's Tesla, still very much a divergent high right there on Tesla. And again, Tesla had bullish divergence like most of them did recently, and that was the catalyst for the rally. But here we are at resistance. Again, these are lines I've had here. That's resistance line created back on October 28th, 235.50. Reaction low right there. It's minor resistance. The top of the gap is a little bit above that if it wants to push up a little bit higher. So that's it. There's your update on the Mag 7, and just kind of show you the weightings. I haven't updated them recently, but see, Tesla's only 3.6% of QQQ. You go up here to Apple. Apple's, again, as of, I just moved a line. I didn't mean to move. As of the last time I checked, it was back in June. It was 12% of the NASDAQ 100. Microsoft was actually 13.25. So just those two stocks alone make up 25% or 1/4 of the returns of the NASDAQ 100, which is insane. So again, it's like great to trade, but it's not the market. It's not what the stock market is doing. What the stock market's doing is what equal weighted S&P 500, VTI, that Vanguard diversified small, mid, and large cap ETF, things like that. So there it is. Let's just keep it simple. As of now, we're very overbought. Probably a lot of short covering today, which then will open the door if the market does want to pull back for a little bit deeper drop, if those shorts have capitulated and covered. Like I said, all in all, right now, nothing but bullish price action. So let me just be clear on that. Like when I look at VTI, for example, in SPY, they've popped the trend lines. They're even above this uptrend line right here. But the day is not over yet, so that's what I'm looking at, nor is the week. So right now, the post I got out to you today earlier, really, I think it's a good time to hone in on the weekly charts and look at the big picture, and then see how these candles close, because of two things. I'm suspicious that this breakout will stick, but more so, we have a very thick economic calendar this week, as I showed you. Today was just the first one. The CPI numbers were cool. They came in a notch below, like a tenth of percent below on all numbers, if I glanced it right. So it wasn't like super cold, but again, all that has to do with, now we're going to segue back into treasuries. Again, treasuries, by far, one of the best looking setups. And I'm going to show you something here. I've done this for many years. I've run this site, and I know you can get a very good feel from the comments as to what trades folks are taking and what they're not. And I've always said this. I put out obscure trades, sometimes like corn, soybeans, or treasuries, and everybody wants tech stocks. Everybody wants what they can talk about at the cocktail party, the names they know and what goes up and down. And that's usually evidenced by the activity in the comments section. The more, obviously, it makes sense, right? More of a trade people are in and taking, the more comments related to that trade you're going to get in the comment section below those posts. So here are all the posts. When you click on any tag like that, it'll bring up the previous post. That's the symbol tag. Those are links. Anytime on the site, anything changes color like this link. So this was the setup here, and you can see it's right there. Zero comments on it, meaning whatever, at least at that point in time. I know a few took it. Don't get me wrong. I've had a few comments since, but not a lot. And there it is. Take suggested position size, beta adjusted position size, and you can also, when you hover on the site, if you don't know what a term, I make a lot of things up. A lot of these are just terms I make up, and so I kind of give you a definition if you go there. And so I talked about, whether then or at the time, I believe we were actually long equities at the time, based on all those divergent lows and everything, but said it would be both a indirect hedge to a swing short position on equities and beta up 2.0. And so, like I said, it would be, you'd be vastly outperforming the rally, even if we were short, if you were short the Qs the whole time. Now remember, we were long the market, QQQ and the big, big tech and all that at the beginning of this rally, based on the divergences, things falling to support and everything else. I just regrettably got out too early, but this trade is certainly. And this is more of a position trade. Now I'll tactically trade it too, and that's where confusion might set in. I pointed out a bearish rising wedge for a pullback trade, and that's just active trading stuff. But as far as a swing position trade, I'm going to get to the charts in a second. Still looks good. So that was the first one, the original setup here. A lot of times I'll cover TLT will be in with other analysis on other things, but here's an update on Treasury bonds. 3 comments, and you look at those 3 comments, and nothing to do with Treasury bonds. And that's fine. You can comment ask for updates on anything under any post, but someone wanted to know about the stock market, when to short again, and then I guess there was one comment here. Someone might have took the 10-year. Anyway, you can go through there as the updates go on this trade. There's very little comments, questions, anything on it. So that's that. And it's simply the point being, diversify, and when there are mixed technicals, and most certainly, and you've heard me say this now going back for almost a month now, regarding QQQ and the big fangs, repeatedly saying this is the most bullish setup I've seen since the beginning of 2023, recently, with these positive divergences and everything else as it played out. And it also aligned with the fact that treasuries look bearish. So shame on me for not milking everything up to here at this point. So right now, look, all I'm looking for at this point is a tactical pullback trade based on those 60-minute divergences. Where to? Let's do that now. We've already hit, remember, this was the first support level pullback. We hit that, and then we exploded off there. So expected a reaction there, just not that high. And I still have, and I will still maintain these targets here on the 60-minute chart. I just toggled over. That was a 60. So that's the same downtrend line. Remember, we had the breakout, back test. That was initial support. Then you have price support here, all down here, this whole range, and then this uptrend line. So yes, that would be a logical pullback target right there. And so I'm still keeping these on, T1 all the way down here. T3 is really, and it would work this way, guys. If you have an uptrend line, and as of now, that uptrend line is below prices. If we went straight down, well, you don't go straight down. Over time, trend lines change. So what would happen is you'd zigzag down, and you'd probably come in here around this time after zigzagging down to a back test of both the trend line. That would come in with that initial price target, that T1 there. Maybe down here to T2. It depends on if and how far we come back down. Oh, and then, or if you're a more active trader, obviously this is what all eyes will be on when we pull back, and I think we'll pull back soon, is a backfill of the gap at minimum. And the traders usually almost always step in at least to have a minor reaction on the backfill of the gap. Could be a bigger reaction, and I always say this. I say this a lot. If you have a differing opinion than me on any security, whether it's these indexes, bonds, crude oil, any other trade out there, anything I'm providing analysis on, my skill sets lie, I believe, in identifying key levels. And so a bull can take the other side of the trade and want to buy that to, let's say you missed this gap up today and you want to get in. Well, certainly that's a very objective place. If they backfill the gap, if you think the markets are going a lot higher, other than that, maybe another back test of the downtrend line. However, this is why I like to do these videos. I'll get to bonds here in just a second. There's that whole if A equals B and B equals C thing, or more of a if this then that. That's probably the way I should say it. So let's just say QQQ. Let's say those 60-minute divergences pan out, and they result in let's say a back test that's now, if you look at the, that's about 4.5%, the pop-up box on the left, to come back down here to back test the trend line again, right? So now let's look at the diversified indexes. I'll use that VTI I've been using lately. What would it wouldn't pull back. Most likely it wouldn't pull back as much as QQQ because there's less beta in here. That's more diversified. But let's say that it does. And this one could. It has small caps in it as well, and they tend to fall more. But even just a 2% pullback is going to get you. And I'm going to move this line, guys. I'm going to move this line right here. We really have two. We have the gap there, but I'll just keep that line there. I just tweaked it slightly, well, because I wanted to come in on that reaction high. And we have these two candles here. I'll just put it right there. So here's where I'm going with this. So if we do pull back only 2%, that puts us back down below this trend line here. We have this primary. That's a very significant uptrend line. And that's why I talk about, trading off the weekly time frame if you're a longer term trend trader, longer term swing or trend trader. So just a 2% pullback would take us in for a back test of the trend line. And then that 4.5, let's say we get more than that. Let's say we get close to the 4.5 I showed you on QQQ for a back test. That would take us down back below here. And that means this whole thing, when you close the week, you'd have a red candle that would look something like this. Let me box tool it here, color it up, make it red. Again, you could see something along this line of a big red candle that puts you back below there, and that would be bearish. Now, that hasn't happened. Here's what I can tell you for a fact. As of now, this move is very bullish. It's taken out the downtrend line and that uptrend line in one fell swoop. Okay, and that's as of right now. Based on what I showed you on the 60-minute charts and everything else, and we have, and I'm watching Treasuries, because Treasuries really are going to make or break this rally. That whole, I didn't even put the divergence on WTI, I had it on all the other indexes. That whole very tight correlation between Treasury bond prices and the stock market still very much exists. So we're going to roll into that real quick. But let me just show you a few others. You have RSP, the equal weighted S&P 500, that's broken out too today. So it's going to take about let's just say about a 4% pullback to fail the breakout of all these trend line breakouts. And RSP, the equal weighted S&P 500, even the regular weighted S&P 500, which is certainly important. This is SPY right here. Let me grab it. It's going to be about right there. We have to fall only about 3% to fail the breakout. And so as of now, there's a breakout that's bullish unless it fails. All right, so I'll say no more on that. Now let's just look at Treasury bonds. We'll look at IEF. IEF has popped the downtrend line. It's at this resistance here. And you have a little bit, it's more of a resistance zone from about 92.55 up there. 60-minute chart, taking out the trend line as well, you can see. So again, if it falls back much more than that, that would be a failed breakout. And again, this is where I talk about going out to the weekly charts. So this is the weekly chart IEF. This and TLT are the reasons I've gotten very bullish on bonds lately, because this is the most bullish setup. This is by far, you look at the chart, it's very clear, at least my trading style. This is a beautiful wedge, and it's just breaking out right now. This week is not over yet. In fact, we're only on Tuesday, early Tuesday. There's still a lot on the economic calendar this week. There's a breakout, but as I mentioned, pretty good resistance just above. So if the breakout sticks, probably come into some resistance there, get a pullback, maybe back test. Again, this big divergence right here, the only time we've had anything comparable to this in years was this same big positive divergent low in the same almost identical, well, different shape, but another beautiful bullish falling wedge. And we got it. We were long and strong Treasuries there. That was a big rally in Treasuries. And again, so this, unless this fails, this whole breakout and these divergences burn through, that's bullish. And I'm going to show you TNX. We're focused on the 10-year right now. Again, this is a super significant uptrend line. This is our primary uptrend line. This is yields going higher. This is where the market started to dismiss them, thinking rates were over by bonds, but then they didn't. It's this final surge we got that gave us that big correction that we just had in the equity markets, and then it was this little abatement here. And look, it's only been 1 month. These are weekly candles, 1, 2, 3, 4, and again, that is absolutely the catalyst for the stock market rally. And you can see right now, in real time as I do this, the yields are breaking below that level. However, this is a weekly chart, and therefore how we close the week is going to be very, very important, because if we get back up on or above that trend line, then that will be a whipsaw. Let's go to the daily. You can watch it on the daily. As of now, it's constructive. And then let's just go to TLT, because that's the trade we're in, at least the one I made official. Just because, again, as I said, sometimes I'll trade the 10-year, and I'll often trade them both. But when my confidence is high, I'll trade TLT for the juice. The higher tends to go up and down more in percentage terms due to the fact it's longer term maturity, so more duration in the bond. Duration is just how much it responds to a change in interest rates, how much the price responds. So TLT, remember, after the trade on the 60-minute chart, which was first posted as a setup to be triggered on a breakout of the bullish falling wedge on the 60-minute, which we got there, then I followed up with just two targets for swing, just one official target right there, about $92, minimum swing target without any of the zigs and zags. And then this potential second target. So I'll still be watching this. If we get this, unless there's a big shoe that drops in something in the financial markets, with a hedge fund or a pension fund or a bank or a non-bank financial blowing up or something along those lines, then this should be bullish for equities if we get this. Go down to the 60-minute chart. That's right here. Let me move these lines. You can see we're also diverging. Remember, it's not coincidence that the stock market on the 60 has that negative divergence, and so does TLT. So we had it here, as I pointed out recently. We had a divergent high, and we got a pullback. I'm going to now move that support line to right there. Now we have additional divergence. And look, the thing about divergence, these are momentum indicators, and right now they're pointed higher. The angle, the slope, it's clearly pointed higher. So this divergence line I have, all I'm saying is we have divergence. It's not a sell signal. It can expand like this. It can even go something like this, and this could go like that, and we may make it up to T3. I don't know, but I know we have divergence, and my thoughts on the equity markets, and due to that correlation, you want to know what I think? I don't think we're going to get to T3 without another pullback. So you can either keep, again, I'm just speaking what you want to do. Most of you probably are not short the equity markets right now. And if you weren't, you probably, just knowing how most work, won't want to short today. And that's one reason that I am. Just from kind of not for the sake of being contrarian, but for those reasons. I think we'll see. If we close up today, I would put good odds that we'll be down tomorrow, and I think we'll probably reverse at some point today anyways, or by the end of the week be down. That looks pretty certain with those divergences and resistance coming up. Okay, I'm almost done here. Let me just show you futures. So this is, where this was the maximum target. The day I gave you the TLT trade, I gave you ZB, Treasury bond futures. That's usually what I'll trade. They're just the futures and get a little more juice. And that was a breakout. Again, it's been just a great trade. And this is the maximum. I think that correlates with that TLT target I gave you. But I've had these levels here for a while. This is resistance, 115, 234. Right there, you have a reaction from above, reaction from below. Carry that over. You had negative divergence. That was that bearish rising wedge. And now you still have divergence on this marginal new high, just like you have on the QQQ. So my guess is that may be it for today. And this is ZN, the 10-year Treasury. Again, this is a potential target, and I think a pretty likely one. But as of now, this is where we stopped before with divergence, and we're kind of pushing the limits here of the divergence, but we still have it there. We could push up, but I see limited upside right now. So that's the common theme, guys. I see limited upside in treasuries right now, and I see a likely and imminent pullback in equities, and that's that. So despite the breakout today, based on the 60-minute charts, the overbought conditions, everything else, I really like it. And so where I came into the day, with a relatively mild short position, I'm pretty aggressively short right now, and in the equity markets. And so I'll let you guys decide what to do yourselves. I'm going to wrap it up here, and then I'll go on the hunt for additional trade ideas. Again, it's that whole diversity thing. There's a lot of other trades out there, not limited to commodities, crude oil, everything out there. In addition to individual sectors, doesn't have to be commodities or bonds, but other sectors. And, the more you diversify, the more it's going to smooth out the bumps in your portfolio. All right, but this video, we just stuck with the stock and bond markets again because they're tied at the hip. To do one without the other is incomplete right now in my analysis. I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.